The stock market is currently closed on this Monday, June 15th, 2026. And looking back at the last active trading session on Friday, June 12th, Plug Power closed at exactly $2.76 per share, marking a daily decline of 2.47% after fluctuating between an intraday high of $2.85 and an intraday low of $2.69, with a substantial volume of over 49 million shares changing hands. While the immediate surface view shows a volatile asset struggling to maintain its footing below the $3 threshold, the hidden narrative driving the order book right now is a dramatic institutional tug-of-war that most retail investors are completely missing. While daily retail sentiment swings on every minor clean energy headline, the massive trading volume we are seeing reveals that larger players are actively positioning themselves around a massive structural pivot inside the company's financial core. The real story isn't the minor 2.47% drop on Friday, but rather a fundamental shift in how the market values speculative clean energy assets in a high interest rate environment where patience for cash-burning firms has completely worn thin. The common ground shared by the broader market is easy to spot. If you scan the major investing sites or read the general commentary surrounding green hydrogen, the conventional wisdom is that Plug Power is a structural cash incinerator destined for permanent dilution. Investors have grown deeply cynical after watching decades of unfulfilled promises, huge accumulated deficits, and a share price that sits at a fraction of its historical peaks. The prevailing narrative says that until macro conditions dramatically shift or government subsidies cover every cent of production, this company is a dangerous gamble for anyone engaged in self-investing. But if we challenge that consensus and look beneath the surface at the actual intraday mechanics, a completely different reality emerges. The expectation was a continuous, unmitigated cash burn, but the reality is that the company is undergoing an aggressive operational triage called Project Quantum Leap, which is forcing gross margins to improve far faster than the market anticipated, dropping its adjusted net loss to just 8 cents per share in the opening quarter of the year. When you track recent stock movements, the daily swings tell a story of extreme tension. Over the past year, Plug Power has actually managed an impressive recovery from its absolute lows, climbing significantly from its 52-week low of $1.03 to establish a new base here in the high $2 range, even after pulling back from a brief run towards its recent high of $4.58. This volatility is a playground for short-term traders using a high-leverage interactive brokers trading platform or a nimble Robinhood app. But for institutional investors managing large blocks, it represents a complex rebalancing act. Wall Street analysts remain sharply divided, with a heavy concentration of hold ratings, but a few aggressive buy targets that stretch up to $7, proving that no one can agree on where the baseline value truly sits. Trading volumes have spiked significantly on down days, which usually signals panic, but the corresponding support at the $2.50 line indicates a steady accumulation by institutional accounts that are quietly absorbing the selling pressure from exhausted retail holders. This intense market momentum is deeply tied to the broader macroeconomic pressures hammering clean energy. As central banks hold interest rates higher for longer, capital-intensive businesses are being punished severely, forcing investors away from speculative green plays and into cash-flowing tech juggernauts like Nvidia stock or defensive safe havens like Apple stock. In this climate, a company cannot survive on a vision alone. It needs cold, hard operational efficiency. The options market for Plug Power shows an implied volatility that dwarfs the broader indexes, indicating that traders are bracing for massive binary swings around upcoming compliance updates and regulatory milestones. Comment below how many shares of Plug Power you currently hold, or if you prefer sticking to more established corporate giants in this volatile market. The institutional footprint from entities like BlackRock and Vanguard remains surprisingly sticky, holding a combined stake that runs deep into the hundreds of millions of shares, showing that while retail traders might flip their positions on a Robinhood stock trading interface at the first sign of trouble, large-scale wealth managers are playing a much longer compliance-driven game. To understand why this recent stock action is so polarized, we have to look directly at the underlying business model and what the company actually does. Plug Power is focused on building an integrated end-to-end green hydrogen ecosystem, moving far beyond its early days of simply manufacturing fuel cells for forklifts. Today, its operations span the entire life cycle of hydrogen, from production and liquefaction to transport, storage, and material handling equipment. The core of their forward-looking growth relies heavily on their Gen-Eco proton exchange membrane electrolyzers, which are massive industrial machines that use electrical currents to split water into hydrogen and oxygen gases. If the power source for that process is renewable, the resulting product is completely green hydrogen. The business sells these electrolyzer systems to massive industrial clients, while simultaneously building out their own domestic network of clean fuel production facilities to sell the physical hydrogen directly to commercial fleets. Historically, this business model faced a massive structural flaw. The company was selling fuel at a staggering loss because it lacked the internal capacity to produce its own hydrogen at scale. For years, they were forced to buy expensive liquid hydrogen from third-party industrial gas companies on the open market and resell it to their customers at fixed, lower contractual prices, leading to horrific gross margins that hit negative 55% in previous years. This past financial report card is exactly why the stock carries such a massive credibility deficit on modern investing sites and across major platforms like a Fidelity trading platform. The historical numbers show an accumulated deficit that has climbed to roughly $8.2 billion since the company's inception over 25 years ago. It has been a classic example of a company growing its top-line revenue while simultaneously widening its net losses, a pattern that caused massive capital destruction during the clean energy bubble burst of recent years. However, the reason the stock has suddenly found a floor in 2026 is that the recent financial reality is beginning to push back against that grim historical expectation. In its most recent first-quarter earnings report, Plug Power managed to surprise the market by delivering revenues of $163.5 million, comfortably beating Wall Street projections. More importantly, the company's electrolyzer revenue skyrocketed by over 340% year-over-year, hitting nearly $41 million for the quarter. This is a massive development because electrolyzer equipment sales carry significantly higher profit margins than physical fuel distribution. By shifting their revenue mix towards high-margin industrial equipment, management managed to drag their gross margins up from that disastrous negative 55% all the way to a negative 13%. While negative margins are still nothing to celebrate at a traditional individual broker, the trajectory of the recovery is what has short sellers feeling incredibly nervous. Looking into the future, the outlook for Plug Power hinges entirely on a few critical catalysts and highly distinct scenarios. The most immediate milestone that the entire market is watching is management's explicit guidance to achieve positive earnings before interest, taxes, depreciation, and amortization by the fourth quarter of this year. If they hit this target, it will completely rewrite the thesis on the stock, proving to skeptical wealth advisors using interactive brokers or looking through a sophisticated Fidelity wealth management lens that the business can actually sustain itself without constant emergency capital raises. The company is leaning heavily on Project Quantum Leap to achieve this, using strict inventory management, price increases on their fuel contracts, and a dramatic reduction in capital expenditures to protect their remaining cash reserves, which currently sit around $223 million. The optimistic future scenario for the stock is built on an immense commercial pipeline that currently exceeds $8 billion. This includes massive international agreements, such as a recent contract to supply 30 megawatts of electrolyzers to a green hydrogen project in the United Kingdom, and a historic front-end engineering design contract for a 2,500 megawatt system in Canada. Furthermore, the massive power demands of artificial intelligence data centers are creating a surprise secondary market for hydrogen fuel cells as reliable backup power systems, an angle that has captured the attention of aggressive growth investors who track enterprise tech trends. If these massive global projects transition from the engineering phase into full commercial deployment, the company believes it can achieve positive operating income next year and hit complete corporate profitability by 2028. For an investor utilizing a self-investing strategy through online investing accounts, this represents an asymmetric turnaround play. Conversely, the pessimistic scenario is rooted in a very real existential liquidity risk. With an unrestricted cash balance that leaves virtually no margin for error, any unexpected operational delay, equipment recall, or supply chain bottleneck could force the company back to the equity markets for another round of highly dilutive share issuance. They operate in a brutally competitive global landscape against well-capitalized industrial peers, and their reliance on complex regulatory frameworks makes them highly vulnerable to political shifts. In Europe, the business is getting a massive lift from strict clean energy mandates, like the RED III directive, which could require gigawatts of capacity by the end of the decade. But if those political mandates are delayed or rolled back, a massive chunk of Plug Power's projected demand could evaporate instantly.
This structural fragility is why conservative long-term portfolios, like those managed through an automated Schwab Intelligent Portfolio setup or conservative Fidelity IRAs, typically steer completely clear of such highly speculative single stock bets. When you weigh these two opposing futures, the core investment thesis always loops back to that fundamental tension between market expectations and operational reality. The broader market expects Plug Power to fail because history says it always has. It views the company as a perpetual cash burner that cannot survive without external help. But the emerging reality shows a corporate structure that is aggressively cutting away its dead weight, expanding its high-margin industrial equipment sales, and rapidly narrowing its losses. For active traders execution-focused on platforms like Interactive Brokers stock trading or everyday investors managing their balances via a SOFA active investing account, the stock has transformed from a sleepy green energy play into a highly reactive, high-stakes battleground where any incremental operational success can spark a massive short squeeze. In summary, Plug Power's current market position is defined by this exact crossroads of intense skepticism and radical restructuring. The Friday closing price of $2.76 reflects a market that remains deeply hesitant, treating the asset with extreme caution